So the Harper's Ferry Corp sells all products on 30-day trade credit. And Bolivar and Company CPA is performing an audit of the Harper's Ferry Corp and is becoming familiar with the departments and documents of the beverage wholesaler. So Bolivar CPA is hopeful that they can reduce control risk to a minimum level. What does that mean? Yeah, they're hoping to be able to rely on controls. And if they can rely on the controls, then they can reduce the level of risk. And as a result, they don't have to do as much testing, right? But they're saying only if control activities are found, which include segregation of duties and safeguarding of assets. So this is what they're looking for within the cycles. Now, for each numbered item, choose which department within the organization, within Harper's Ferry Corp, the client is likely to perform each task for proper internal control. So at the client, which department is likely to perform each task? Choose only one department. If the department is not listed, choose none of the above. So here's the list of the departments from billing, sales, credit. We know that's the revenue cycle, right? Shipping would also be the revenue cycle, but receiving would be the purchasing cycle. Unless goods were coming back that were sold and now they're coming back, then they might come in through receiving. But receiving, we know, is where the goods first come in when we buy something, so that's expenditure cycle. Warehouse would be both. You'd have the revenue cycle and expenditures would involve the warehouse. Vouchers payable would be the expenditure cycle. Accounts receivable would be the revenue cycle, sales cycle. Cash disbursements would be expenditure cycle. Then we have human resources and payroll. And then none of the above. You ready? Okay. In the revenue cycle, the department that should not be allowed to authorize a bad debt write-off because they would be executing the write-off once permission is granted. When we did the sales cycle, what department did we say will end up executing the bad debt write-off, so they shouldn't be authorizing it also? Well, billing, their job is to send out the sales invoice at the end of the revenue cycle, right? They have to have a copy of what two documents first? The sales order and the bill of lading. Billing has to have a copy of the sales order and a copy of the bill of lading. And if they match, then billing prepares the sales invoice. Okay, that's their job. Then accounts receivable has to maintain some type of a ledger so that if a customer's account is getting older, it may need to be written off, but accounts receivable who's going to actually write it off, they should have someone else in the company authorize the write-off. They shouldn't be able to both authorize the write-off and write it off. So accounts receivable is the department we're looking for the answer to this question. The department that should not be allowed to authorize a bad debt write-off because they'll be executing the write-off once permission is granted, that's accounts receivable. Yeah, the authorization of that write-off should come from the treasurer, who is the credit manager's boss. We don't want the credit manager authorizing the write-off. That's because the credit manager is really not a high enough up position in a company, and authorizing a write-off is a pretty big moment for somebody like the credit manager. So it wouldn't be the credit manager who should authorize the write-off. It should be the credit manager's boss, who is the treasurer. But that's not what this particular question is asking. This question is saying, within that revenue cycle, who should not be allowed to authorize the bad debt write-off because they're going to be the ones that actually write it off, and that's accounts receivable. Accounts receivable will ultimately go into the ledger and scratch that customer out and say, they're a deadbeat. They're never going to pay. But they shouldn't be allowed to authorize the write-off, give themselves permission, and then write it off. They shouldn't be allowed to do both. So the authorization of the write-off should come from the treasurer, who's totally independent of the sales cycle. Treasurers and cash disbursements, not cash receipts. So then the treasurer should authorize the write-off and accounts receivable should write it off. Now in number 2, in the payroll cycle, the department that maintains hiring date, department, salary, and position now we're changing gears. The payroll cycle. Sure. Human Resources has the authority to hire new employees. Payroll shouldn't have that authority. Human Resources should maintain personnel records like hiring date, department, their salary, and their position. So the question asks, in the payroll cycle, what department should maintain hiring date, department, salary, and position? Not payroll, but Human Resources. They're not the same department. They're in the same cycle. As far as the auditor is concerned, that's the payroll cycle. But they're not the same department. They shouldn't be. Because one has authorization, that's Human Resources, and one has record keeping, payroll. Three, in the revenue cycle, yeah, payroll's an accounting function. Payroll's accounting. Human Resources is authorization. Three, in the revenue cycle, the department that should approve the sales order before goods are shipped to the customer. The whole point of having a credit department is that somebody should approve the sales order based on whether or not that customer has the credit to be buying. Because remember, in this question, they told you that this company, go back up to the top, they sell all products on 30-day trade credit. So that means the company, your client, Harper's Ferry Corp, is going to ship inventory to those who place a sales order. To those who place an order, they're going to get a shipment of goods prior to payment. That's why it's important for the auditor to make sure that the Harper's Ferry Corp is doing their homework as to who they're shipping these goods to. Because you don't want to be shipping goods to someone who has no intention of paying. Right, exactly. Credit is authorization, and that's what number 3 is asking about. Who should approve the sales order before goods are shipped? Credit. Number 4, in the expenditure cycle, the department that should approve the voucher and record the payment to the vendor after the payment is made, but should not be allowed to mail the check. Yes, exactly. Vouchers payable is the one who should do that reconciliation and approve the voucher, approve the invoice for payment. That's an accounting rule. They should not sign or mail the check, though, but they should record the payment in the cash disbursements journal once the payment's made. What vouchers payable does, if you remember, is they get a copy of all the documents. Right, they make a vouchers package out of it. They put the voucher on top, which is the approval for payment. And then underneath the voucher itself are the 4 supporting documents. What are those documents? Right, your purchase requisition, purchase order, when the goods are purchased, they ultimately come in, purchase, well, then there's a receiving report made by the receiving room, and then purchase invoice. So all 4 documents go along with the voucher, and that's the voucher package. And when the vouchers payable department approves the voucher, that's the approval for payment. They don't pay the bill, but they approve of it. So once again, in this question, in the expenditure cycle, the department that should approve the voucher and record the payment to the vendor after the payment is made, but should not be allowed to mail the check, that's vouchers payable. Now we go back to the revenue cycle. So they could do this on the exam. You're bouncing around from one cycle to another on a CPA exam. After you learn the cycles, this is a great way to test you whether you remember it, and you can see how it's good review. Right, the sales invoice is always prepared by billing. That's the end of the revenue cycle. It's the 3rd document in the cycle. First you got the sales order, then the bill of lading, prepared by the shipping department, and then once the billings department has a copy of both the sales order and the bill of lading, they match them up. They make sure that if the sales order says 10,000 bushels of peaches at $5 per bushel, the bill of lading should say the same, indicating that 10,000 bushels were ordered and 10,000 bushels were shipped. And if they all match up, then the billings department should prepare the sales invoice. Notice the billings department doesn't prepare the bill of lading. That's easily misunderstood. The billings department does not prepare the bill of lading. The bill of lading is prepared by who? Shipping. Right. All right, now we bounce back to the expenditure cycle. And in the expenditure cycle, the department that should receive a blind copy of the purchase order and prepare a document indicating what goods arrived from the vendor. Yes, that's right. Exactly. So the receiving room needs to know pretty much what's coming in so that they'll accept only what they're supposed to accept when the truck arrives. But the receiving room should not know exactly how many items are coming in because then they wouldn't be forced to count them in. We want receiving to do an accurate count, and the only way to force them to do that is to leave them in the dark as far as how many are coming in. So if we ordered 8 blue dining room tables, they might know that they're blue dining room tables coming in, but they shouldn't know how many are coming in. This way they force them to count them in. That's all about the receiving room. And the receiving room is often not a full-time job for people in the company. So often those people who are doing that second job, they're not really that motivated to do it because it's a second job, and they run out there. You want them to be able to count these items in. You don't want them to just say, oh yeah, okay, I got to do this today, and here they come, just throw them in the warehouse. So you force them to count them in by not telling them how many are coming. All right, 7. In the payroll cycle, the department that should approve employees' hours worked, including overtime hours. Who should approve the employees' hours worked, including overtime? Yeah, the answer is none of the above. All payroll hours should be approved by the department supervisors. That's why you have supervisors, because they should approve the hours worked, the overtime, and the regular hours worked. Human resources, they won't know if the people worked those hours or actually worked them or not. They just know that they were authorized to work for the company, human resources. And payroll wouldn't know. Payroll's asking, should we pay these hours to these people? Did they really work? So someone has to approve the hours. That should be the department supervisor. So none of the above for number 7. 8, in the payroll cycle, the department that should consistently hand out the payroll checks to employees that do not already receive direct deposit. No, this is none of the above also. In the payroll cycle, see, we didn't go over the payroll cycle together. That's why I wanted to do it this way, because you don't really have to go over the payroll cycle. There's just a couple things you have to know about the payroll cycle, and this is one of them, is that the payroll checks, if you're still handing them out, it should be handed out by someone who's not involved in this cycle at all. So not someone from human resources, not someone from payroll department, and certainly not the department supervisors. Because if the department supervisors handed out the checks, you'd actually see the checks going backwards through the system. And remember, we said checks should never go backwards. So once they're printed by payroll, they should not go back to the departments for the supervisors to hand out. And the reason for that is that if a department manager, let's say, put some fictitious employee onto the payroll, convinced human resources that someone's working for the company that's really not there, or maybe never took somebody off the payroll who was working and no longer works, and never notified human resources that the person doesn't work anymore, then that department manager would be able to perpetrate that fraud and cash that check if they got their hands on the check. So the department supervisor should never get their hands on payroll checks for people in their departments. Those checks should be handed out by an independent paymaster, which is kind of like another second job in the company where you're not really getting anything extra for it. Maybe you're getting something, but it's not your first responsibility, but you kind of take it seriously because it's everybody's pay. So who does it? It could be a secretary in a department on a rotating basis. Maybe a secretary will do it for 2 or 3 months, and then they'll rotate it to somebody else. It's a very low-level position that'll come in and just fill this role temporarily. I know when I go into government buildings, sometimes on the 15th or the 30th of the month, they'll have a paymaster at the end of the day handing out checks because that's when the government gets paid, 15th and the 30th. So if you're in IRS's building or if you're in some other type of federal government official building, that's what you'll see. An independent paymaster, someone just handing checks to people as they leave. And that should be done not by anybody in payroll and not by anybody in human resources, and certainly not the department supervisors, but just some random secretary on a rotating basis should be an independent, quote, paymaster. All right, number 9, in the revenue cycle, the department that should only be allowed to move goods within the organization and not be allowed to send goods outside the company to the customer. That's right. The warehouse should only be allowed to move goods within the company. Should not be allowed to move goods outside. Right. Shipping should get the goods from warehouse and get them ready to send outside. All right, number 10, in the expenditure cycle, the department that should match up the vendor invoice to the purchase order and receiving report. That's right. Yep. Department that should match up the invoice to the purchase order and receiving report, that's your vouchers payable department. What's their job? Authorize the payment of that invoice. They don't actually sign the check, though. But they might prepare the check and send it to cash disbursements for the treasurer to sign. "11, in the revenue cycle, the department that should prepare the bill of lading." Right. Shipping prepares bill of lading, but not before they match up what? Well, they got to match. All there is a sales order at that point. But they got to match up the sales order received from credit to the sales order received from the warehouse. So if the warehouse brings over 100 cases of Snapple iced tea to the shipping department, shipping says, okay, I see you gave us 100 cases of Snapple, but shipping needs to know that 100 cases of Snapple were approved by credit to be sent to this customer. So shipping, before they ship out, they've got to match the sales order received from credit with the sales order received from the warehouse. 2 sales orders. If they both say the same thing, 100 cases of Snapple were brought over from warehouse and 100 cases of Snapple were approved for shipping from credit, then they can ship them out. But what if it says only 20 cases were approved by the credit department and 100 cases were brought over from the warehouse? Then they should not ship those goods out without further investigation.